Hello and welcome to Yadnya Investment Academy. Today we are going to discuss more complicated scenarios on income from house property topic in this part 2. In the part 1 we discussed introduction to house property income calculations and understood how notional income is taxed under house property income head. We discussed details about gross annual value, net annual value, municipal valuations, fair rent and standard rent as per Rent Control Act. We also discussed various scenarios on how income from house property is calculated, such as if you just have one self-occupied property, if you have one property in which a portion is self-occupied and rest is rented, or when a property is self-occupied for few months and rented for rest. In this part, we will discuss two little more complicated scenarios. That is when you have two house properties, one is self-occupied and other is rent out, or both are self-occupied. First, we will discuss first scenario where you have two properties and one is self-occupied and other is rent out. Let's understand this with an example. Suppose you own two houses, one in Delhi and one in Mumbai. You have taken loan on house in Delhi of rupees 40 lakhs and interest on the loan is rupees 2,50,000 per year. For house in Mumbai too, you have taken a loan of rupees 35 lakhs. Interest on the loan is rupees 2,20,000 per year. Delhi house is self-occupied and Mumbai one is rent out and fetch a rent of rupees 40,000 per month. And fair rent of the house is rupees 35,000 per month. Municipal taxes paid by you for both the houses are the same of rupees 10,000 each per year. Here are the calculations. Since Delhi house is self-occupied, all the values will be zero except deduction due to interest paid on home loan. Maximum limit set by government on section 24 is rupees 2 lakhs. So even though interest you are paying is more, still you will get maximum 2 lakh deduction here. Now in Mumbai house, gross annual value will be yearly actual rent as it is more than fair rent. Then municipal taxes are deducted from gross annual value and you get net annual value of rupees 4.7 lakhs. Now to get income from house property, you need to deduct standard deduction of 30% from net annual value and also interest paid on home loan on this property. Now in this case, even though maximum limit of this deduction is rupees 2 lakhs, you still get rupees 2.2 lakh deduction benefit since your house is on rent. This extra benefit is now removed from 2017-18 financial year but is valid on previous financial year, that is 2016-17. There is no limit of this benefit if your house is on rent. More details in our section 24 video. But remember, from 2017-18 financial year onwards, this value will be rupees 2 lakhs only. So after deducting these two, we get this as income from Mumbai house, and adding both we get loss on house property of rupees 91,000. Now let's discuss second little more complicated scenario where you own two houses and both are self-occupied. So in case you own more than one house property and both or all are self-occupied and not rent out, which means either you have made one of them as your residence and use the other one for some of your own purposes like a holiday home. In this case, you will be allowed to treat only one of the properties as self-occupied and all others are considered to be rent out. Please remember, any one property can be chosen as self-occupied property. For the remaining properties, one or more, there will be an assumption of being rent out. Tax department does not impose on you which of the property should be considered as rented out. That choice is completely yours. Now here is the opportunity to save tax. Choose the house you would want to declare as rent out where you have higher interest cost and lower annual value, and this will in turn reduce your overall tax liability. And let's understand this with the same example we discussed in the previous scenario. In the example, we have added fair rent of Delhi property and removed actual rent of Mumbai property as both are actually self-occupied. Question we need to ask here is which property should be considered as self-occupied to decrease the tax liability. Firstly, let's see the income from house property with Delhi as self-occupied and Mumbai be treated as on rent. Doing the calculations in the same way as before, taking fair rent as gross annual value, we get income from house property in this case as loss of rupees 1,33,000. Now considering Mumbai house as self-occupied and Delhi treated as rent out, this is the calculations going to be. Taking Delhi's fair rent as gross annual value, we get income from house property as loss of rupees 2,89,000 in this case, which is a higher loss than this. And therefore, this scenario where you consider Delhi as rent out and Mumbai as self-occupied property should be taken and shown to income tax department to save higher tax. Please remember, these scenarios are valid for only 2016-17 financial year, and from 2017-18 these values will change to rupees 2 lakhs, and therefore scenario in your case could change as well. That is all we have from the part 2 of this topic. If you have any question, please do write in the comment section below, and do not forget to subscribe to our channel for more such videos. Have a great time ahead.